Anuj, man, what's happening?
Not much, man. How you been?
I'm very good, because you're on the podcast now, finally, after I think
Yeah.
around 1 year, we've
Annual
got you back on.
annual podcast session, mate. You get the better insights from the better people at Harbour
Exactly.
usually. Phil's on holiday, so I'm filling in today.
Now, I don't think you're filling in. You're like our finance pundit, the mortgage pundit.
Yeah, yeah. So it's said.
Yeah, exactly, man. Now, I'm very excited to have you on today. It's a big one, a very big one today. So we're talking about our predictions for 2026 for the property market. So obviously, this is going to be covering a lot of things, macro. We're looking at every city breakdown, what happened this year as well. So it'll be a quite interesting discussion. I know we've kind of had a chat offline to what we think, but this is purely like, we're hearing for the first time together what we're predicting for the new year, and especially from a lending perspective, we'll get some insights there as well. So I'm excited.
Sounds good, man. Yeah, looking forward to it.
Yeah, man. So what I'll do, I'll just share my screen. So I just want to quickly touch base on what we saw happen in 2025 as a whole, and how we predicted the market December last year. We went through a very similar to model what SQM Research does. So we have a kind of our base case scenario for what we think is the most likely, scenario happening for the year, what we think that will translate from a growth perspective for each city. So just very quickly touching on 2025, I think we did a fairly good job because we did predict the March rate cut, the first quarter rate cut. So that was pretty good. And obviously with that, that was a fairly bullish, prediction of the market. We were actually, quite conservative here, looking at actually what happened in 2025, because we
Yeah.
did see all cities have growth, which was pretty crazy. And I think as soon as we saw that rate cut in Q1, the market kind of grew. Just to give
Mhm.
you a bit of insight as to what really did happen, so Perth, we predicted like that 10 to 15% range. So we saw that growth pretty much in line. I think Perth actually outperformed by about 3%. So we did about 18% growth. Brisbane
Mhm.
again above 16%. The real miss for us last year was Darwin. So Darwin, we
Yeah.
actually saw like a massive 20% growth in Darwin. And in all honesty, we haven't bought a property there, but I think it's really investor led, but we'll talk about that at the end another time. And Hobart and Canberra, we still saw growth. So with that rate cut, saw it grow. So I think what we're looking at this year, we're looking at a very similar model to
Mhm.
our prediction. And what we've done is again talk about four key scenarios which we think that will basically be the most likely coming into the new year. And
Yeah.
today, what I'm going to talk about is just our base case. So we'll post this online, but our base case is actually a global slowdown. So
Mhm.
we've discussed this a bit offline, so we're going to go into a bit of
Yeah.
detail here. But what I think will actually happen in 2026 is we will see an economic slowdown across, Australia, even in the US. And I
Mhm.
think that will basically result in more economic softness in our economy, some rise in unemployment, which means they might have to stimulate the economy a bit more, which actually means a bit more rate cuts. So
Yeah.
now I've predicted growth, and we've at Powered by predicted growth for every single capital city in most of the bullish regional markets. Obviously,
Mhm.
the growth varies across each city. Now, that's purely because, again, supply, historically low supply in the market, so that will create a floor in the pricing. And there are economists out there, even Domain thinks that that first-time buyer scheme is equivalent of like 4 to 5 rate cuts. So even if they don't cut rates over the next 6 months, there's a lot of demand, a lot of stimulus. There's now a help to buy scheme as well. So with the
Yeah.
supply shortage, continuous, demand in the market. And if there was an economic slowdown, don't get me wrong, this is just an aggregate view of each city. But we will see suburbs in each city decline more than 10%. I mean, we saw it in Sydney, we saw it in Melbourne this year. You're more
Yeah.
unaffordable pockets. So we're not buying 1.5 mil plus. I'll keep shouting that from the top of my lungs. There is a risk
Yeah.
there if the economy does contract. So we're still focusing on the right fundamentals, the more affordable markets, own occupied focused. But
Mhm.
basically, the real growth drivers, I think the main cities aren't really changing. So I think Perth, Brisbane, Adelaide will continue to see growth with that supply shortage. I just want to shout out, I have predicted Darwin to grow in
Yeah.
2026. I think that kind of investor boom will
Change your
continue
tune.
there. Yeah,
Yeah.
I think the real undercover market will be Melbourne. So I
Mhm.
think Melbourne, I think it's already started that, massive market cycle in
Yeah.
2025, and that will only continue. Some suburbs in Melbourne will actually be the best performing in the country, I believe. I think
Yeah.
Sydney, there'll be kind of a mix, your more affordable pockets under that, 1.2 mil mark will keep outperforming, whereas the more
Mhm.
unaffordable pockets, big risk. And I think a lot of investors will kind of go into Hobart. So, but overall, I do see markets having growth. I still see regional markets growing, but I think capital cities will have their time to shine first, given that first-time buyers grant. But
Mhm.
one thing I will talk about as well later on is just I think the key in 2026, the theme will be Australian property will stand out as a high performing growth asset versus other assets in the world. So
Yeah.
I think we'll see a, maybe a potential correction in the share market, other correction in equities. And I think people will realize how safe housing is in Australia. What are your thoughts,
Yeah.
man?
No, man, it's a lot of info, and I totally agree with I guess most of what you're saying. You're right in the sense that I think when you look at property, it seems a bit bizarre. Well, how does it continue to keep going up and up and up? And I think the key issue here is sort of the lack of supply and the government, doing some sort of fiscal stimulus quite regularly to try to keep the demand up. So when supply is choked and demand's high, that pushes prices up, and that can be, the case even when fundamentals are pulling in the opposite direction. I think we've seen stress in the market definitely recently. Not a collapse, but a slowdown definitely coming. Business insolvencies, and unemployment, other things like that, were highly correlated to the US market, and I think we're seeing how that's going, and we've seen some corrections in the equity. So I think Q1, Q2, we're probably going to see a bit of a slowdown. We might still continue to see growth, but it's going to slow down. I think Q3 and maybe even Q4, there might be a bit of pain in the market, but I think overall, if you were to look at it in aggregate over the full year, I still think property is going to continue to perform, reasonably well and still grow. I think you correctly identified there definitely are going to be pockets that correct, but
Yeah.
I think if you normalize that over sort of the short to medium term, they're not going to be too material. And in terms of certain pockets and certain cities, I'm not too close to how much each city will grow, but I agree with you on certain things. Like, for example, I've looked into Melbourne a fair bit myself, and there seems to be a bit of a disconnect between the level of economic activities that are happening in certain cities versus the asset growth and the price of houses. So I think we're going to see some interesting stuff. And yeah, I agree. Risk adjusted, I think Australian property seems to be a very, strong performing asset. People have always said it's a bubble, it's going to crash. And, 30 years later, there's just things that keep it propped up. How
Yeah.
sustainable it is, I don't know. But what I do know, it's kind of realmed into the too big to fail kind of situation where if you allow property to really crash, it's going to have a big domino effect, which is going to
Mhm.
basically tumble our whole economy. So
Yeah.
government typically doesn't like that and doesn't let that happen. And they've got, their magic wand. They can do a couple of things to sort that out. So I think overall, man, I agree with your predictions. I think we are going to see growth. It might be a bit slower than this year, but I
Mhm.
think you're going to have this sort of contrast between certain pockets pulling up, and then you're going to have a sort of minority of pockets which are going to correct and move downwards. As long as you're buying in the right fundamentals and you're taking a medium to long-term approach, I still think you're going to do pretty well overall.
Yeah, yeah, and I think you made a really good point about some, pain and weakness if the economy does slow down. And to your last point, that's where we have to be very careful in locations we do buy in, and
Yeah,
obviously not buying at the top of the cycle. Like the market has been growing for the last few years, so it's important to understand there could be a hot market today, but if you're only seeing, growth potential for the next 12 months and that market kind of, stagnates and stops growing and you're stuck in an asset that doesn't see growth for long term, are you making the right decision? So these are all the things looking at with clients because this is kind of like a crucial inflection point with a lot of the markets today. So that's very
yeah,
crucial. And I know
yeah,
like this seems very bullish. Like there's a lot of green on this chart. It's a very bullish chart overall, but
yeah,
this is an aggregate view. I think you
yeah,
you read out really well. There will be some pain because
mm,
if there are any kind of corrections in other markets, like your share market, US driven, whatever it is, that will cause an unemployment rise. That
mm,
will ensure that people find it difficult to buy or hold properties that are more unaffordable. So
yeah,
within, Sydney, where there's, markets that are like 20x your household incomes, those
mm,
those markets are not going to be, growing at the same rate as different markets in the country.
yeah,
In fact, they'll be declining. They're declining this year as well. So there's a lot of kind of nuances into how we should look at this market. But overall, I think as an asset class, as from a growth perspective, you will see it stand out. And I think that's kind of where I'm trying to go with this in 2026. When if other markets are correcting and Australian property is still so stable, I think because to your point, they can't afford to let property correct as well.
yeah,
There needs to be more stimulus coming to the economy. So, if the share market is having a correction and some parts of the property market having a correction, they need to stimulate the economy, which means more rate cuts. And that's kind of what
mm,
we've predicted. I think
yeah,
a lot of people are scared today that there might be a rate rise. I
yeah,
don't think that will be the case. Our economy
yeah,
is pretty much in a per capita recession. Unemployment's
mm,
rising. It's not going to be easy to cut rates today. I think it will really cause a lot of stress in the market. Consumer
mm,
confidence is still low. their expectations for prices are high, but the confidence is low. So there's a lot of demand still yet to come, stimulus yet to
Yeah.
come to the market. And the
Yeah.
government's already done what they can with their first time buyer schemes, help to buy schemes. So people are
Yeah.
coming in. So it's just understanding, what makes sense.
Mm.
But overall, like with that global slowdown case, there is, yeah, again, growth across each city. But there are other scenarios that we think that may be, potentially happening. But I think this is still our base case. But
Yeah.
I think what I'm really trying to say is that when property takes over as, this outstanding asset class that will see growth, and it's kind of in a way recession proof or whatever it is,
Mm.
then you get more demand flowing here because when rate cuts come more inflation. In an
Yeah.
inflationary environment, people want to put their dollars, their hard-earned cash into assets that will grow, outperform, and like a
Yeah.
tangible asset. So
Yeah.
you've seen gold and silver just, rocket
Yeah.
up in value the last few years. Same will happen to property, and that's where all this
Yeah.
kind of come through. And I know it's like with your clients, so you deal with a lot of sophisticated investors, even home buyers. Like, what's the sentiment and where they're buying or where they're trying to focus on for the next year?
Yeah, no, really good question. I think, look, the sentiment is, I think there's a bit of caution, in
Mm,
terms of where to buy. I think in the last year or two, one thing I've seen is you could sort of throw a dart at a map of Australia and land somewhere and you buy property and you probably make money.
mm,
And even though there's been, some strain in the economy, I think property has just been sort of going up pretty aggressively. And that's all good and well. But I think when you come under times of economic stress, then it's the fundamentals which drive the property growth. A lot of these suburbs which saw these, really high levels of growth were kind of driven by, I call it momentum trading, well, like what people do in
yeah,
equity, right?
yeah,
Tesla shares going up, let me go buy Tesla shares. And then people have started doing this in property, right? Like Townsville is a really good example. That suburb went up a lot, and then you thought the cycle had peaked, and then you had this
yeah.
influx of buyers saying, "Oh, everyone's making money there. Let me buy," right? But what
Mm,
happens is when economic stress comes into the fold and unemployment rises, money gets a bit tighter, it's a little bit harder to spend, then, you're not going to have all this investor activity and you're not going to have this sort of growth, which is just purely driven by over demand and under supply. So I think a lot of my clients and the people I've been speaking with have really just, and it sounds very simple, but just taking it back to basics and making
yeah,
sure where we're buying is not a sort of short 1 year, 2 year plan where I can make, 5-10% in the short run and pull out some money and, go again. It's more taking a longer term view and saying, hey, look, there's going to be a bit of stress here. I really need to be making sure I'm buying in areas where, you've got good infrastructure, proximity to a capital city, or, good population growth, just your sort of basic things. So
right.
I think I've seen across the board a bit of a pullback on people being, not that they've stopped buying, but I think they're becoming a little bit more cautious with what they're buying and making sure that the asset and the areas they're targeting are underpinned by your sort of, fundamentals. So I think that's going to be really important moving forward. And, as you said, I think there is a bit of uncertainty, right? You have assets at sort of all-time high prices, and then you also have debt at a sort of all-time high, and then all these things which are sort of counterintuitive all happening at once, right? So I think there's just a little bit more caution coming in. And look, a lot of the people I've been speaking to have been sort of, Melbourne's been a pretty popular place to buy recently, as you said earlier. But I think buying near capital cities, and knowing which suburb to buy is, I don't think it's extremely difficult. I think if you put in the time, you can figure it out. But I think it's really important to get a good deal as well, because
Yeah,
it's very easy to overpay in these pockets as well, especially as people all start to target the safer areas. You're going to have more demand going in and being sort of shoveled into fewer suburbs.
yeah,
So I think that's one thing which is what I've seen with my clients is they're focusing more on fundamentals and targeting the slightly safer areas, or just
sure.
making sure there's something that's going to continue to make these areas grow, even when this, sort of period of inflated demand sort of dies down a little bit, because I think that's what we're probably going to see a little bit of next year. You're going to
Yeah,
see the investor market cool off a little bit, and people who have bought well and safely will probably still continue to do well. People who have probably bought at the top of the cycle or just sort of jumped on the bandwagon and things like that, I think there might be a little pain for them, because I definitely think there are suburbs which are,
yeah,
overvalued, like, quite significantly. So
yeah.
that's sort of what I'm seeing. Hopefully that's helpful. I can drill down on something there if you want.
No, I think that's awesome, man. Like I fully agree with what you're saying. I think 26 will be a year where it kind of separates smarter buyers from, people who are just kind of, to your point, just, just throwing a dart at the board and hoping they'll land on something. And I think like just the way, because the market's been growing continuously the last few years, stimulus, I mean, there was no supply, some areas are very undervalued. That's changed a lot now. So overall, I think the market will continue to grow. But even the suburbs within your hottest markets like your Perth, your Townsville, whatever today, that will be slower. That will have some kind of pause, or I don't think they're necessarily correct in some of those really hot pockets. But even a pause for a 2 to 5 year period, the
Mm.
opportunity cost versus another property that grows for the next 5 to 7 years, that's massive. That's like,
Yeah.
the difference between buying another property or two if you can take out some equity and keep scaling. So there's a lot of kind of ways to look at, what the client's goals are today.
Mm.
And if you are, to your point, long-term focused, if you have the right fundamentals, most likely that type of property will fit in a lot better than someone who's very short-term sighted, they
Yeah.
want to buy for like a 12-month hold. And in property, it's very crucial to educate people that if you get in with a short-term mindset, you're not going to make profits. It's very difficult. Even if you get the sale and you've got some profit there, you've got costs going into a sale, like your stamp duty, you've got costs going out, your commission fees, your taxes. There's nothing that guarantees good profit in that short term. So really look at property from a long-term kind of view. We're at
Mm.
a point in the market where you have to do that now. There's
Yeah.
no debate about it in my views. And I think to
Exactly.
your point, again, we're very capital C focused. That's great.
Yeah.
And I think one thing I really want to touch on with you is a lot of changes coming to lending, man. So some
Yeah.
very interesting predictions from maybe your side on what's happening with specific trust structures. I know we've kind of been in that space quite a lot with some clients to help them scale a
Yeah.
portfolio.
Yeah.
I know we've talked about it a lot offline. So what is your kind of view on the changes we're seeing in that landscape? What do you think we're going to see in 2026 with APRA coming in, making a bit more adjustments to
Yeah.
how we can get the lending?
Yeah, no, I think the credit space is been really interesting, and I think it's very relevant to all of this stuff, right? Like, we look at the credit cycle, and it seems to have been just going peaking and doing so well for so long, right? Yes, there's been some introduction of things over the last 2 years that may be tied in credit, but also there's been a lot of ways where you can just continue to get debt, right? And I think recently what's happened is arrears are not high, but they're rising. They're not at a point where it's at, alarming or anything like that, but there's a slight trend upwards. And, in trust lending, that actually, I've spoken to, a few people. I don't have all the data because it's quite limited, but from what I've gathered, that trust lending has actually been performing for the bank worse than your normal loans because, you know, it's, it's being sort of being abused a little bit, and APRA can't really turn a blind eye to it, right? So I think the first blow was kind of Macquarie. Macquarie were a really great lender for this trust stuff, and they would basically allow you to, do plenty of them for the right investor and the people getting the right advice. It was a really useful tool, right? I think
Yep.
what happened is, it's really great to share information and try to, make sure everyone has access to it. I think we need to be cautious that we don't push people to do something that maybe they're not educated to do or they don't understand. And I think that's what I saw a little bit on, LinkedIn, YouTube. There's all these
Yep.
media coming out saying, hey, do this, do this. But I think, as you know, like there's a really quite thorough process you should be going through to actually understand what are you getting yourself into, because lending under a trust is, it takes you outside the boundary of certain protections, which, are designed to protect your average consumer. So I think with Macquarie, they sort of saw a lot of this stuff, and they saw maybe the performance of some of their, how the book's going. I don't know, but based on the overall trend, I'm guessing there was some stress there. I think the other thing is there's a lot of touch points with trust loans, so they decided to kind of say you can do as many as you want to, you can do one, and then that blew up online, right? And that sort of poured fuel on the fire, and they're like, you know what, we're not going to do this at all. And then you had sort of CBA follow a little bit. They're not completely out of it, but they're making it more difficult, right?
Yep.
And a lot of the credit originations which have been happening over the last year have been through this trust structure, all right? So it sort of begs the question if other lenders go into the fold as well and start tightening this trust lending stuff. And you've already seen like lenders like NAB,
Yep.
who have increased their interest rates for these types of lending. ANZ did this a year ago where their rates were quite high for trust lending because it's associated with more risk. So if
Correct.
this continues to happen and people can't buy in this trust, then that's going to add to sort of a credit contraction. And that's going to maybe also cause things to slow down a little bit. Again, as we said earlier, if things slow down, they'll drop interest rates. So, that's the ebb and flow of it. But I think trust lending slowing down is important. I think APRA has to crack down on it because it's all good and well when everything's working, but that's only at the early stages. When there's pain in the economy and defaults start happening, people can turn around and point the finger at APRA and say, you should have known about this, so you got to do something. And I think they know that's sort of coming out. So they've been investigating this stuff, which is why the banks are getting cautious.
Yep.
It's also this new DTI cap that they're looking at introducing in February next year, which is
Correct.
6 times debt to income, right? And I think that's important as well. So, I mean, just to round off trust lending, I think is kind of, if you've already got loans in a trust, I think you may benefit from that. But I think what you're going to see in the future is maybe some of the majors step away from it, or they increase their rates. It gets a little bit more difficult to use this product. I don't think it's going to disappear completely. You can't just sort of, turn off the tap because that has flow-on effects. But I
Mhm.
think maybe because it's a bit more risky, it might get phased out a little bit, and
Yeah.
that's obviously going to have an impact on the market. I think yeah, this DTI cap, I've worked at credit in a few major banks. 6 times debt to income ratio, it basically means if you're earning 100K, as the bank deems it, you shouldn't be having more than a 600K loan, right?
Correct. Yeah.
If you look at the multiples required to buy a house today,
Mm.
I don't really know how that makes sense. I think a lot of this is targeted at slowing down some of the investor activities. You got
Mhm.
people racking up absurd numbers of properties and they're trying to battle this now. So I guess this is part of de-risking.
Yeah.
What I can tell you is 6 times DTI cap, that was already a concept in most banks. They
Correct.
already knew that once you go over 6 times, you're in a dangerous territory. I know certain banks, automatically kick it into a senior
Mm.
person has to look at this because it's high risk. You need mitigants for this. And really, the hard cap was 8 times. If you've got someone who's got 8 times DTI,
Mm.
the banks would just kind of automatically decline it in the residential space. So
Yeah.
I don't think it's anything new under the sun, this six
Mm.
times DTI cap. But I think if it does get mandated that you actually cannot give any lending above 6 times, that is going to have an impact as well, because this is going to tighten your availability of credit, right?
Yep.
Now, I mean, what happens when things like this happen? You turn off one tap, you open up another tap, right? They added all these sort of, haircuts and shading for income. And then people thought, well, this is going to be, the tightening of the screws. We can't get any more debt. And then all of a sudden you have this arbitrage or this, trust lending thing you can do, which opens up the door. So
Mm.
I think whilst these things will come in and they will sort of tighten things, which is their purpose and which is actually required, you can't allow things to run rampant. I think as you progress through it, Australia's economy is highly linked to, property, right? And
Yep.
we can't just stop that, or you have a massive effect on the broader economy. So what's going to happen is they're probably going to open up new pathways or new ways to continue, credit originations and making money. Because I think people forget the banks want to make money as well, right?
Correct.
Not that we forget, but when you're going for a loan, the bank wants to do the loan as well because they make money. And it's not realistic to just tighten everything and shut it all down. So I
Mm.
think yes, we are seeing a tightening in the credit, and that's typically the first sign, like, or an early indicator that there's more stress to come. I don't think this is like doom and gloom. I think, yes, there's going to be some tightening and it is required because there's people sort of, taking lending at levels they shouldn't be doing it. Like if
Mm.
I'm being very frank, and you need something to come in and counteract that. And that's what some of these changes will do. But as it's been historically with Australia, if you turn off one tap, you open up another. So credit will basically just move into another type of origination. It may
Yep.
slow down. And as I said, if property prices start to correct or move downwards too much, it's a big problem. We
Yep.
can't, again, too big to fail. So economic activity slows down, the government will have to maybe cut rates or they'll have to do some fiscal stimulus. They'll have to do something, right? Because people need houses or people need to be able to live. We're in an affordability crisis, it's very difficult. And our economy is run, this is part of our bread and butter. So yes, you have a responsibility, you have to protect the people, but part of that also means that you can't let our economy crash, right? So I
Exactly.
think that's the kind of ebb and flow I'm seeing in the credit. And I'm seeing directly with banks, yeah, it's getting a bit more difficult for certain things. People are trying to move over and sort of de-risk a little bit, but it's natural because we've had this insane bull run, right? Like, people
Yeah.
have just been originating. You take a moment, you take a beat, you step back, you see the playing field, you reset, you pick another path you want to go down, and then they're going to open up the doors to that.
Correct.
So
Yeah.
I think we're just in that transitionary period. As we said, there's going to be a bit of up and down, but overall, we
Yeah.
should get to a point where we normalize and we open up some new pathways to continue things moving forward.
Exactly, yeah. I think you put it in a put that in a really good way because these kind of tightening of trust structures or whatever measures APRA comes out with, I think it's more targeted at sophisticated investors or people that are taking on too much leverage to try to buy as many properties as they can. This is actually to stop, risky lending or not let people get over leveraged just to, increase their property portfolios. It's not really impacting, first-home buyers or anyone in that kind of space. So I think that's a good thing and it's required. But to your point, like they're not going to go overboard with any restrictions on lending because this year alone the property market gained $1 trillion in value. It's now worth $12 trillion. So
Yeah.
it's literally like 85% or something of the economy. So we
Mm.
can't. afford, to your point, to have anything, correct here. And you're right, if they turn one tap off, they have to turn the other tap on because this essentially is too big to fail. But overall, I think what's happening right now is the loan to value ratio on that $12 trillion. I think there's only about 2.6 or $7 trillion of debt on that $12 trillion of residential property. So we're still in a really good space overall. I think what's happened the last maybe 5 years, I'm just guessing since COVID, especially a lot more awareness around lending structures, a lot more awareness about how property can help you, grow your wealth and you can, increase your portfolio like to a sizable amount and do X, Y, Z. So I think people have been more responsible. And I think because of that, these screws have come in. But and I think those are the main people at risk from even being, over leveraged in the market. So if there were to be any corrections on their properties, then you have a risk. But I think overall
Mm,
the market historically is strong. But I also think that's kind of a bad thing because in my opinion, I think the top 10% control these assets, correct? I think what we're seeing
mm,
in the market today, I've called this the most hated property boom of all time, just
mhm.
because you're not seeing a lot of new people come in. It's very
Yeah.
difficult for new buyers today to, buy a few properties or get into their own home in the city of their choice. And I think that's purely because, again, prices keep rising, wages aren't growing as fast. Now, this is a whole other topic, but overall, I think the measures they're taking won't affect that kind of buyer. It's more
Mm,
about your sophisticated investors. And we can't
yeah.
even get the investors out of the market, by the way, because an investor buys a property, then that property's there for rent. We're also in a
Mm,
rental crisis. So there's a few ways you've got to look at everything. But overall,
yeah.
yeah, I don't think they're just gonna, take out trust lending or, keep making up more regulations on, lending strategies or whatever it is. It's going to be very open to all the market.
Mm.
And I think just one more question to kind of wrap it up today, man. Like, do you have a hot take for 2026?
Oh man, I'm
I'm
not
putting you
good
on
at
the
hot.
spot. I know I'm putting you on the spot.
You know, I'm pretty risk averse, right? Look, I wouldn't say it's a hot take. I think we've probably discussed it, and I think we're in agreement. Look, my view is I think next year around Q3, so sort of July, to September type of time, and towards the end of the year, I think we're gonna see probably a bit of a correction there. I think that's gonna make things slow down a bit, but then I also think we're gonna see an inflection there where towards the end of the year we're gonna have to sort of retaliate to that, and then things
Yeah,
are gonna start to recover and start to grow again towards
yeah,
the end of the year. And yeah, I think that's probably a very boring. I don't think it's a hot take. I think it's just a statement, which is probably a little bit boring. I don't know if you were hoping for something a little bit more interesting, man. But
no,
I
no,
think that's it. I think we will see the credit cycle sort of contract a little bit, and I think
yeah.
it's the natural flow of things. If everyone's making money and if everything's going well, then there's something which is wrong because that's just not how things work. Unfortunately, it would
Yeah,
be
everything
lovely.
can't just go up in a straight line
Yeah,
forever.
everything can't just keep
Yeah,
going up. Assets can't just keep going up all the time. There
yeah,
has to be something that fixes it, and it's going to be painful, but it's going to be, it's necessary. So
yeah,
I think next year we should see a little bit of that, which will hopefully then, set the pace for maybe 2027 and 2028 thereof to kind of, start to see some more sustainable and sort of longer term growth.
yeah, yeah. I think I'm kind of in the same boat as you from a hot take perspective. I think from an equity share market perspective, again, like we've talked about this, but I think US market will lead some kind of correction in
Mm,
sometime in 2026. I think it'll be fairly significant. I think it'll be around that 30% range as an example. If that was to happen, they'll cut rates more than anticipated.
yeah.
A lot of economists today think that there's going to be minimal rate cuts next year, maybe even a rate rise. I'm completely not in agreement with that. I think it'll be
Mm,
quite the opposite. I think they'll cut the rates more than anticipated. But the flow-on effects for that to happen, to cut rates more, I think there will be suburbs that correct more than 10%.
yeah.
And I don't think the suburbs will personally focus on from an investor perspective. Obviously,
Yeah.
an occupied home is a very different conversation, but there will be suburbs in like, Sydney. And you think about your Mossmans of the world, your Vaucluses, your Kirribillis, like, anywhere with a median price point to more than like $3 or $4 million. They are
Yeah.
the luxury market. There are a lot of wealthy people there, but these suburbs are the most at risk from any unemployment rise, any economic slowdown. So I think those suburbs will see a correction.
Mm,
And another hot take, I don't know if it's a really hot take, but I think in a lot of the major capital cities for the next 2 years, there will be specific locations where apartments kind of have more growth than houses for the
mm,
short term. I think this kind of been happening for like last year in some locations. I think that'll continue because house with land value will kind of be too unaffordable. And
mm,
then your apartments or maybe your townhouses will catch up. We may or may not play in that space. I'm not really sure yet. I don't think we'll play in the apartment space. Maybe we consider townhouses moving forward in some locations. But we're
Mm.
still to look at that in more detail. But right now, still very focused on household land value. Haven't bought an apartment yet, in all honesty,
Yeah.
but still just trying to understand, when's the right time and what locations are the right areas to kind of look at that delta and see that as
Yeah.
an opportunity. But yeah,
Yeah.
like nothing crazy from a property perspective. But I think
Yeah.
the hottest take is that if the equity market declines 20%, what does that mean for your super? What does that mean for how the RBA looks at the need to stimulate the economy, and what does that mean from property prices? So we kind of look at all asset classes and
Yeah.
just make sure that it's all kind of one big market. So everything does have a flow on effect to your point. So we
Yeah.
just want to make sure we're on the right side of things. That's the main thing.
Yeah. No, that's some really good predictions, man. And I think with if things do go down, we typically print more money.
Yep.
Hard assets typically perform well in those circumstances. And
Yep. Mhm.
so one remark on the apartment thing, I think it's a good point you raised. Like, I don't think we're quite there yet, but I think if
Mhm.
you look at some other capital cities which are maybe comparable, we're a younger country, Australia, but if you
Sure.
look at like New York or
Yes.
London, and Singapore's young but maybe quite developed. Eventually, you do reach this point where the land is sort of restricted, your population's growing, you need to house
Yep.
people, so apartments make a lot more sense, right? So
Yep.
I think there probably will be a time. I think we've got a little bit to go still, but
Yep.
I like that take. I think apartments over the short to medium term, sorry, maybe the medium to long term, they're going to become pretty relevant for Australia, but maybe in some of these other markets, yeah, next year
Yeah,
I'll be
yeah. I'm
interested to
saying
see
more from like a growth percentage perspective, like
Yeah,
because housing will be too unaffordable in some of those locations.
exactly.
They're very undervalued in some locations today. To your point, like now is not the time to say long term I'm going to hold this and it's going to outperform
Yeah,
houses. But
yeah,
I think in some locations it'll do well. So let's just see what
yeah,
happens.
yeah. It's going to
Have
be
to keep an eye on
interesting. Let's
that.
see. Fingers crossed. It's all positive and good news in
Exactly.
2026. But let's see.
Exactly, man. Actually, last question for you. Any New Year's
Yes.
resolutions?
New Year's
I
resolution.
love
Oh
putting you on the
man.
spot. You're on my
Yeah.
TV. I got to ask you random stuff.
Got a massive list, man. New Year's resolution is to do more than one podcast with
Mine was
Raga.
to get you more than one pod next
Yeah,
year.
there you go,
Done.
man.
Done,
We're
done.
aligned. We're aligned. Nah,
Awesome. I like that. I like
we'll
that.
do it, man. Let's see. And then I tell you what, in the next one I'll give you my actual list that I'll come up with and on 1st of Jan.
Awesome. Sounds good. Sounds good. Now, pleasure having you on, man. Really appreciate it. It's been a
Lovely to
pleasure.
talk, man. Thanks for your time, Raga. All right.
Cheers, bro. Enjoy.